Welcome back, friends, to another weekly video. We are all aware about the financial crisis that is affecting markets all over the world. Almost exactly 2 months ago, the stock market in the United States crashed. And the question we're going to be looking at today is this crash over, or is it going to continue? What's going to happen next? Are markets going to go up, or are markets going to go down? Now, you know, I don't give predictions on this channel, but this is another opportunity to talk about business history. And so we're going to look at some of the crashes from the past and try to put some historical context onto what is happening in the markets today. Let's start by looking at some of the current financial information for the Dow. The Dow Jones Industrial Average is a pool of 30 large companies on US stock exchanges. People use the Dow as one metric of the performance of some of the best US stocks. Since COVID-19 started, the Dow initially dropped by 37% by March 23, 2020. It then bounced back and has remained fairly flat and sits at a drop of 19% as of Friday. This is following the typical pattern we see in market crashes. There's usually a sudden drop in the market, followed by a period of high volatility as the market stabilizes. Then there's usually a point you can identify where the market recovery begins. So the question in this situation is whether the period of volatility is over and whether the market is on its way to recovery. If this period of volatility is still going on, is there going to be another drop in the stock market? Let us look more closely at what is going on with the COVID-19 crisis. Most of the US is still under some level of quarantine. The unemployment rate continues to increase, although it has been slowing. The Bureau of Labor Statistics released new unemployment numbers a week ago, putting unemployment at 14.7%, the worst unemployment since the Great Depression. However, there was a tweet by somebody named Betsy Stevenson. Now, this is important. Betsy Stevenson is the chief economist at the US Department of Labor, and she tweeted that there was a mistake in the unemployment numbers. It turns out that when they were doing the unemployment survey, that people who lost their jobs due to COVID-19 were classified incorrectly as temporarily unemployed and not included in the unemployment numbers. So the unemployment rate is really nearly 20%. Now we are starting to see bankruptcies in the news. We have seen bankruptcy announcements from JCPenney, Neiman Marcus, and J.Crew. There are rumors of several more major companies on the brink of bankruptcy, and I'm not going to say any of their names online because I don't want to add to the chaos, but you can find the news stories for yourself. The situation is pretty bad. Now, to put this situation in context, I find it helpful to look at how capital markets function at a high level. The way stock markets work is you have a pool of capital where wealthy people invest their money. This money flows to businesses which are legal entities engaged in some business plan. These businesses create jobs. These jobs are interactions between workers and customers that generate productivity. The productivity turns into profit for the businesses, and profit turns into dividends for the stockholders. So in a healthy market, money flows down and back up this value chain. Now let us compare this pandemic to the Great Recession in 2008. During the Great Recession, financial markets collapsed. People were buying and selling mortgage-backed securities that really did not have any value because people were purchasing second and third homes they really could not afford. When all this was revealed, billions of dollars in the financial markets suddenly evaporated overnight. This shut down the value chain and we entered the Great Recession until the financial markets could straighten out this mess. The COVID-19 pandemic is almost the exact opposite problem. Everyone right now is stuck in their homes, either by quarantine or they're just too scared to leave. So we have no workers and no customers. We still have all these rich people who want to invest their money, but no one at the bottom end of the value chain is generating productivity. Businesses are going to go bankrupt, which means stockholders will lose all their money. This is a very bad situation. But the question is really not whether this is a bad situation. The real question is the stock market correctly valued? Is the stock market already taking into account the true impact of the bankruptcies that are coming? If the stock market price already takes into account all this bad information, prices may be on the way to recover. If the stock market prices do not take the true situation into account, stock prices may continue to drop. As I mentioned before, we are currently at a 19% drop in the market. With all the economic damage we are facing, does it make sense that the Dow would only drop by 19%? To address this question, we are going to look at all the stock market drops of the Dow in recent history. As I said before, all these crashes had a dramatic crash, then a short period of high volatility while the market stabilizes. This table marks the percentage drop from the point when the market starts to recover. So I'm trying to compare apples to apples here. I'm attempting to compare our current market level with what would be comparable to the other crashes in history if we were on the road to recovery. So let's walk through these. The September 11th attacks had a 15% drop in the Dow. The dot-com bubble had a 16% drop in the Dow. Now keep in mind that technology companies most affected during the dot-com bubble were not part of the pool of stocks in the Dow, and the NASDAQ and S&P 500 had much greater drops. Then we have the Russian currency crisis in 1998, which had an 18% drop. This is where Russia devalued its currency and defaulted on its debt. Then we have where we currently sit today with COVID-19 at a 19% drop in the Dow. Moving down the list, we get into much larger drops from the Great Recession in 2008 at 29%, which is 10% more than we were at today. Black Monday in 1987, the Dow dropped 30%. Now, Black Monday was primarily due to poor trading practices in the 80s. And finally, we have the Great Depression in 1929, where the Dow lost 88% of its value over a 3-year period. So in the historical context of these crashes, the current level of stock decreases is actually fairly reasonable. The crashes in 2008 and in 1987 were 10% greater, and of course the Great Depression was much greater than that. So let's talk about the Great Depression. There was an immediate drop in the stock market of 43%, but then the market continued to decline over the next 3 years. And over those 3 years, people lost 88% of the value of their investments. Almost all of their retirement savings was gone. Another thing to look at is whether the current COVID-19 crash is similar in character to the other crashes. You would think that the rates of decrease would be closer to similar types of events. Now we know what caused each event. So September 11th was a military attack, the dot-com bubble was related to a specific industry, the Russian currency crisis dealt with a foreign country's currency, and so you can look at each one of these examples and ask whether COVID-19 is more similar to these smaller level crashes or more similar to, say, the Great Recession and the Great Depression. So let's go back to unemployment. The current U.S. unemployment rate is somewhere around 20%, the highest since the Great Depression. Unemployment during the Great Depression was 25%. Now, our current stock market valuation of the Dow is a 19% decrease, where the Great Depression valuation of the Dow resulted in an 88% decrease. So I will ask you again, does the current valuation of the Dow at a 19% loss make sense, given the current economic situation? Are we headed for more decreases in the stock market? Let me know what you think in the comment section down below. The second question is, how long do these stock market crashes last? How long is it going to be before recovery starts again? In other words, when is the right time to buy back into the market? I have also pulled data from all the same stock market crashes on the number of days from the time the crash started until recovery started again. You can see that this crisis has already gone on a long time. We're already sitting at 86 days, which is already the 5th longest recovery period. It does not seem like the recovery from COVID-19 is starting anytime soon. The Great Recession took 301 days before markets started to recover, and the Great Depression, as I mentioned earlier, took 3 years before recovery started again. So let's make a summary of this discussion. We're looking at the question of whether the current 19% drop in the Dow makes sense. Does that stock valuation make sense? And if not, is the stock market going to continue to go down? Now you have to remember that the Dow has remained relatively flat for the last month and a half. And if you remember, the Dow was sitting at a 19% drop when the President of the United States got up and said that we would probably be out of quarantine by Easter. Do you remember that? Well, we have blown past Easter and there has not been any correction in the Dow. Does that make sense? Now we have to be really careful here, because just because something happened in history is not necessarily a prediction that it's going to happen the exact same way in the future. Just because we have all this data doesn't mean we can necessarily draw all these correlations. So we have to be very careful. However, people are making real-time decisions today on what to do with their stock portfolios. And you want to get as much information as you can so you can make the best decision that you can. Because the real question here is the stock market going to go up? Is it going to stay flat? Or is it going to go down? I'm Zach from Wolves in Finance. Thank you so much for watching. Let's go out and make some money.